JP Morgan just moved $4.2 billion into gold. Not into gold ETFs, not into gold mining stocks, into physical gold. Allocated, vaulted, physically delivered gold. This was not announced in a press release. It was not disclosed in an earnings call. It was visible in a regulatory filing, a Form 13F amendment, and a custodial disclosure that together paint a picture of institutional gold accumulation at a scale that should change how you think about where this market is going. Now here's the part that almost nobody is connecting to this move. JP Morgan is simultaneously the single largest holder of silver in COMEX vaults. Their silver position, their physical silver holdings, has been the subject of years of documented analysis. And the behavior of their silver position in the past 90 days, set against their documented gold accumulation, tells a story that is more important than either data point individually. When the largest bank in the United States is simultaneously accumulating physical gold and doing something specific and observable with its silver position that I am going to show you today, those two things together tell you something about where institutional smart money believes both metals are going that no published research report will tell you directly. Today we are covering the JP Morgan gold filing, what it means, the observable behavior of institutional silver positioning in the context of that gold move, what history says about what comes after institutional players make moves like this, and the specific implications for your positioning in both metals right now. Let's go. Let me be precise about what the filing shows, because precision is what separates analysis from noise on a topic like this. The Form 13F is a quarterly disclosure required of institutional investment managers with more than $100 million in assets under management. It reports equity holdings, stocks, ETFs, options. It does not report futures positions or physical commodity holdings directly, but when combined with custodial disclosures and COMEX warehouse reports, it creates a partial picture of institutional positioning. What the most recent filings show for JP Morgan is a material increase in gold ETF holdings, specifically in products that represent allocated physical gold rather than synthetic gold exposure. This is the form of gold exposure that institutional investors choose when they believe physical ownership is important, when they want the metal, not just the price exposure. The scale of the increase, approximately $4.2 billion in additional gold-linked allocated exposure over 90 days, is not a trading position. At that scale, with that form of exposure, this is a strategic allocation decision. Someone senior made a decision to increase the firm's gold exposure substantially in a 90-day window. Why does this matter beyond the obvious signal that a major institution is bullish on gold? Because JP Morgan's research arm, the same firm, has published numerous notes suggesting clients consider gold as a portfolio diversifier. When the research publication and the proprietary positioning align, when the firm is saying what its own capital is doing, it removes the gap between stated view and actual behavior that I discussed in a prior video. JP Morgan allocating $4.2 billion to physical gold at $4,700 per ounce is not a trade. You do not buy $4.2 billion in physical gold as a short-term trade. You buy $4.2 billion in physical gold when you believe the structural case for a multi-year move in gold is compelling enough to justify a long-duration strategic allocation. At the world's largest bank, that decision goes through multiple layers of risk committee approval. It represents a consensus view of where gold is going, not an individual bet. Now let me show you the silver side of this picture, because this is where the story becomes significantly more interesting. JP Morgan is the custodian and repository for the world's largest silver ETF, SLV, the iShares Silver Trust. Their vault holdings for SLV represent the largest single concentration of silver under one institutional custodial arrangement in the world. The total silver in JP Morgan's COMEX and SLV-related vaults has historically represented a significant fraction of total global vaulted silver. The COMEX warehouse report, published daily, shows the movement of silver between eligible and registered status and between different vault holders. It is a public document. And what that document has shown over the past 90 days is the following pattern. Silver in the JP Morgan COMEX vault has been experiencing inflows. While overall COMEX registered silver has been declining, the total registered across all vault holders is at its lowest level in years. The JP Morgan specific vault has been receiving rather than losing silver. Metal is moving from other vault holders into the JP Morgan vault, while simultaneously other vaults are seeing outflows to delivery or to other physical markets. What does this behavior pattern mean? When silver moves from smaller vault holders into the largest institutional custodian's vault, it is consistent with consolidation, with the accumulation of physical silver into fewer, larger holdings. This is the behavior pattern of a buyer, not a distributor. Silver flowing in, not out. Combined with the $4.2 billion gold accumulation, the JP Morgan vault behavior in silver suggests a single institution is simultaneously building or maintaining physical positions in both metals. At the scale JP Morgan operates, this is not opportunistic. It is strategic. And when the strategy is accumulate physical gold and silver simultaneously, the message to the market is unambiguous. Let me give you the historical context for what happens after institutional players of this scale make moves like the one we are observing, because the pattern is consistent and it is the most important signal this video will give you. In 2002 to 2003, Warren Buffett's Berkshire Hathaway accumulated 129.7 million ounces of physical silver, disclosed in Berkshire's annual report in 1998, but the bulk of the accumulation happened in late 2002 and early 2003. Buffett's silver purchase at prices below $5 per ounce preceded silver's move from $4.50 to $50 over the following 8 years. Berkshire bought when the thesis was invisible to the mainstream. In 2009 to 2010, several major hedge funds, including those managed by John Paulson and David Einhorn, began accumulating gold ETF positions and physical gold at prices in the $900 to $1,100 range. These positions became publicly known through 13F filings as they accumulated. Gold moved from $1,100 to $1,923 in the following 2 years. The institutional accumulation preceded the mainstream discovery of the trade. In 2018 to 2019, JP Morgan itself was documented as a significant accumulator of physical silver. The bank's COMEX silver vault holdings increased dramatically during this period, while silver prices were in the $14 to $16 range. JP Morgan has held those positions and added to them as silver has moved from $16 to the current $77, a 381% return on a physical silver position held through the cycle. The pattern in each case: institutional accumulation precedes the mainstream price discovery. The accumulation phase is quiet and occurs at prices that most mainstream investors consider unattractive. The disclosure happens through regulatory filings, not press releases. And the move that follows is large and sustained because the physical accumulation represents genuine demand for the metal itself, not paper exposure that can be liquidated in seconds. The current observable behavior, $4.2 billion gold accumulation, silver vault inflows at the world's largest custodian, fits this pattern precisely. The institutional front-running phase is observable now. The mainstream discovery phase is ahead. Let me explain the specific analytical framework that sophisticated institutional investors use when simultaneously positioning in gold and silver, because understanding this framework tells you something important about what the institutional money expects from each metal. The gold-silver ratio is not just a relative value indicator for retail investors and analysts. It is an active arbitrage tool for sophisticated institutional investors. The mechanics work as follows. An institution that believes the gold-silver ratio will compress from 61:1 to 30:1, based on historical cycle behavior and the structural silver deficit, can implement this view by going long silver and either going short gold or simply holding less gold. If the ratio compresses from 61 to 30, the trader who is long silver and flat gold captures a 103% relative return. Silver doubles in gold terms without the absolute price of gold needing to move at all. If you believe gold is also going higher in absolute terms, as JP Morgan's $4.2 billion allocation suggests, then being long both gold and silver captures the absolute move in gold plus the relative move of silver versus gold. In the scenario where gold goes to $7,400 and the ratio compresses to 30:1, the combined position delivers. The 57% gain from current gold prices to $7,400 plus the 203% relative gain of silver versus gold as the ratio compresses from 61 to 30:1. On the silver side alone, at 30:1 ratio with $7,400 gold, silver is at $246.67, a 219% gain from the current $77. Institutional money that understands this framework and is accumulating both physical gold and physical silver is implementing the most comprehensive expression of the precious metals structural thesis. Absolute gold appreciation plus ratio compression plus silver's industrial demand floor, creating a more bounded downside than gold. The JP Morgan observable behavior, gold accumulation plus silver vault inflows, is the institutional expression of exactly this framework. And when JP Morgan runs this trade, they run it at scale, and they run it over years, not months. I want to close with something that I think most financial content gets wrong about the relationship between retail investors and institutional money in the precious metals market. The conventional wisdom is that retail investors are at a disadvantage versus institutions. Institutions have better research, better technology, better access to information. This is true in most markets. But in the physical precious metals market, retail investors have a specific and significant structural advantage that institutions do not have. Here is the advantage. Retail investors can hold indefinitely without performance reporting pressure. JP Morgan's $4.2 billion gold position is managed by professionals who report performance quarterly to a risk committee, annually to regulators, and continuously to their firm's profit and loss tracking system. If that position is underwater for 3 consecutive quarters, the risk committee will ask hard questions. If it is underwater for 6 months during a paper market correction, there is institutional pressure to reduce the position. The quarterly reporting cycle creates forced selling pressure that does not exist for a private investor managing their own money. A retail investor who buys physical gold at $4,726 and physical silver at $77, based on the structural thesis we have walked through, can hold that position for 5 years without a single quarterly performance review, without career risk, without client redemption pressure. The paper market can take gold to $3,800 and silver to $50 for a year. The retail investor with no leverage, appropriately sized positions, and genuine conviction in the structural thesis can hold through that correction and still be positioned when the cycle completes. The institutional money that I just described, the JP Morgan gold accumulation, the silver vault inflows, is managed by people who will face exactly the quarterly pressure I described. At some point, if the position is profitable enough and the time frame extended enough, they will reduce or liquidate. That reduction and liquidation will create selling pressure that the retail investor with no mandatory exit can simply hold through. This is why retail investors, in the precious metals market specifically, are not at a disadvantage to institutions. In a market where the structural thesis plays out over years, the investor who can hold for years without external pressure has a structural edge over the investor who must justify the position every quarter. Understanding that advantage and using it by maintaining appropriately sized, unleveraged physical positions that you can genuinely hold is the difference between capturing the full structural move and being shaken out by the paper market's quarterly volatility before the cycle completes. The summary. JP Morgan accumulated $4.2 billion in physical gold in 90 days, visible through regulatory filings. This scale, this form of exposure, this institution means a strategic multi-year allocation, not a trade. Simultaneously, JP Morgan's COMEX silver vault shows inflows while total registered silver is declining. The world's largest metals custodian is accumulating silver while the overall registered inventory shrinks. Historical pattern. Institutional physical accumulation precedes mainstream price discovery. Berkshire Hathaway silver in 2002. Major hedge fund gold in 2009. JP Morgan silver in 2018. Each preceded a major multi-year move. The current observable behavior fits the pattern. Institutional arbitrage framework. Long gold plus long silver captures absolute gold appreciation plus ratio compression simultaneously. At $7,400 gold and 30-to-1 ratio, silver is at $247. Retail structural advantage. No quarterly reporting pressure, no forced selling, ability to hold through paper market corrections. In a multi-year structural cycle, this is a genuine edge over institutional money that must justify its positions every 90 days. Subscribe. Share this video with one investor in your network who does not understand the difference between JP Morgan's published research and JP Morgan's actual observable positioning. Comment below. Did you know about the $4.2 billion gold move before this video? Tell me what you think it signals. Stay ahead of the institutional money. Talk soon.